Picture this. In just 60 minutes, more money than the GDP of a small nation evaporates from the crypto markets. Billions vanish. Panic spreads. The ground beneath traders shifts. What you thought was safe suddenly isn't. That's exactly what happened recently. Over $7 billion wiped out in a single hour, according to multiple reports. The story behind that precipitous crash isn't just about fear. It's a lesson in leverage, liquidity, structure, and the hidden mechanisms that can turn an explosive rally into a flash crash. Today, we dig deep. How did it all unfold? Who lost? Who gained? And most importantly, what should you learn from it? Let's take the timeline, piece by piece. Before the crash, the crypto markets were already teetering on a knife's edge. Volatility had been climbing, and sentiment was fragile. Macro forces were at play. US-China trade tensions had flared again, and geopolitical risks were rising. In particular, President Donald Trump's surprise announcement that he would impose a 100% additional tariff on Chinese goods, along with export controls on critical software, set alarms off in global markets. That kind of unexpected macro shock is exactly what markets dread, because it adds uncertainty to everything: supply chains, future growth, investor risk appetite. At the same time, many crypto traders were riding aggressive leverage, long positions expecting further upside. These are highly vulnerable when the direction reverses. Now, what flips the switch? In this case, it was that tariff announcement. But reactions in markets don't wait politely. They accelerate. As soon as the news hit, traders started questioning whether crypto could continue to behave like a decentralized safe haven. Instead, it turned into a risk asset, dragged along with global equities. On many exchanges, the price of Bitcoin dropped sharply, somewhere below $110,000 in hours, and altcoins fell even harder. Single-session losses of 15 to 30% were reported. But the real shock came in liquidations. According to CoinGlass and other data aggregators, more than $7 billion in positions were liquidated in just 1 hour. Some reports place the broader 24-hour liquidations at $19 billion total. So the fireworks start when the cascade begins. Here is where things get mechanical and brutal. When the price of an asset moves against leveraged traders too fast, exchanges automatically close, liquidate, under-collateralized positions to prevent losses from exceeding collateral. That forced selling adds further downward pressure. In our crash, a majority of liquidations were of long positions, people betting prices would go up. Reports put $5.5 billion of that $7 billion number just from longs. As those positions unwind, liquidity vanishes. Bids disappear. Prices slip in a vicious feedback loop. Some analysts have flagged a more insidious contributor: Oracle mispricing on Binance. Because Binance's price feeds are widely used by other derivatives platforms, when its spot or Oracle feed deviated under stress, collateral valuations shifted sharply downward across the network. That means that some positions were marked unsafe, even before the market fully recognized it, triggering early liquidations that worsened the slide. In extreme crashes, some exchanges use auto-deleveraging, ADL, a mechanism that forcibly reduces or closes profitable positions on the opposite side to maintain system solvency. In short, your profitable trade might be taken from you to keep things balanced. While the heavy machinery of liquidations is executing, human psychology kicks in. Many short-term holders, those who just bought recently, start dumping at a loss, hoping to salvage some capital before the slide deepens. This behavior amplifies selling pressure. One analysis mentioned that many STHs sold at a loss, likely triggered by fear of further declines. The net result: mechanical liquidation plus emotional panic equals cascading collapse. Let me walk you through who bore the brunt of this. Leverage-heavy traders. Most casualties were those with high leverage, little margin buffer, badly timed entries. As the slide exceeded their safety margins, positions were forced shut. Short-term speculators. Those who entered recently, riding hype, were wiped out fastest. Altcoins and smaller tokens. These saw the steepest collapses, Some lost 40 to 80% intraday. Cross-exchange arbitrage/trading systems. Because price dislocations occurred, some exchanges showing different prices than others, arbitrage systems were challenged or broken. Exchanges themselves, to some degree. When liquidity drains and volatility spikes, exchanges risk internal pressure, mismatches, or needing to reimburse clients affected by technical glitches. Binance, for example, acknowledged module stress and issued compensation of about $283 million to affected clients. Meanwhile, some whale traders managed to profit. A notable wallet opened a short position just before the crash and reportedly made around $192 million from one such trade. What followed wasn't just healing, it was introspection and adjustment. Bitcoin and Ethereum saw partial recoveries after the initial shock. Exchanges responded by reviewing oracles, collateral rules, margin parameters, and compensation protocols. Market participants started calling this a leverage reset, a purge of excessive risk built up over time. Regulators, analysts, and institutional investors all heightened their focus on structural vulnerabilities in crypto markets, whether pricing oracles, cross-exchange dependence, or systemic leverage. But more importantly, this event carved out a number of lessons and mistakes to avoid. A crash like this isn't just news fodder. It's a crash course in what can go wrong. Here are the lessons you must internalize if you trade, invest, or even follow crypto seriously. Leverage is a double-edged sword. It magnifies gains, but it magnifies losses even more when things go wrong. If you can be liquidated, you can be wiped out. Always size your leverage with a buffer for volatility. Know your exchange and its mechanics. Understand how the platforms you use do margining, liquidation, oracle pricing, cross-exchange dependency, and auto-deleveraging. A glitch in one exchange's oracle can propagate damage elsewhere, as we saw in this crash. Cointelegraph liquidity matters. In fast crashes, markets become illiquid. Big sell orders push price far out of line. Getting stuck trying to exit is dangerous. Don't let fear or greed run you. Short-term holders panicked and sold at the worst moment. If you're trading, have a plan, stop losses, and don't be ruled by emotion. Tail risk is real. Sometimes extreme events, macros, policy changes, global shocks, happen. Be prepared. Don't assume smooth upward gains forever. Diversification and hedging. Don't put every egg in one basket. Use hedges, reduce exposure, consider safe haven allocation. Monitor the macro, always. Crypto is no longer isolated. It's becoming more correlated with global markets. Macro shocks, tariffs, interest rates, trade wars are real drivers now. So where do things go from here? A few considerations. The market could remain volatile, especially if there's more trade escalation or macro surprises. Some believe we might see further deleveraging as many traders remain cautious. Exchanges will refine their technical infrastructure, especially oracle systems and margin rules. Longer term, this might weed out overly speculative participants and lead to a more resilient base. Smart capital may view the dip as a buying window, but that comes with risk. This $7 billion crash in 1 hour was more than a headline. It was a wake-up call. It exposed the fault lines, leverage, pricing oracles, exchange interdependence, and human psychology. If you trade, invest, or even watch crypto, internalize those lessons. Don't let surprises ruin you. Build for resilience, not just upside. If you found this explained well, and you want more deep dives like this, be sure to hit subscribe, click that bell, and drop your thoughts in the comments below. Did you get caught in that crash? What did you learn? Which exchange mechanics surprise you the most? We'll keep analyzing, keep telling truth to the market, and help you build strength in volatile times. See you in the next video.